Before leaving the floor to Marie, let me, and thanking her for, for holding this webinar, let me thank the Collegio staff for making this webinar possible and supporting us throughout this hour. Marie will be thinking, we had agreed to organize as follows the seminar, like approximately 1 hour speech by Marie, which, given that we have so many, we wouldn't really interrupt, but for clarification questions that you can write on the chat. And so I will ask them as she goes along. And otherwise we could gather questions at the end. So Marie, the floor is yours. And thank you again for delivering this seminar.
Thank you very much, Giovanna, and I would like to thank you and also the center, the Collegio Carlo Alberto, for inviting me for this seminar. It's a great pleasure to be here. And I'm immediately going to share my screen to show you the presentation. I hope you can see it. Is it all right?
Well. Yeah, perfect.
Okay. So, as you said, Giovanna, I'm going to present a research paper on personal values, responsible investing, and stock allocation. And this is joint work with Stefano Ramelli, who is at the University of Zurich. So maybe before I start presenting what we did, just give you a little bit of background about the importance of social responsible investing, especially for retail investors. And there is a lot of empirical evidence that it is becoming more and more popular among retail investors. If you look at some figures, for example, in Europe, the retail products, they now account for more than 30% of SRI assets, while it was only 3.4% in 2013. So there was like an exponential growth in retail investors' demand for SRI assets. And there was the same growth in the US, where the retail demand for SRI is about 25% of the total market. So there was a strong growth for in the demand for these social responsible funds. And this growing demand that we can observe is also visible among participants in pension funds. And in the US, it's particularly visible for 401k plans, for example. And it has been really discussed in the press. You can see here a couple of newspaper articles from the FT or the New York Times, accounting for the fact that more and more workers are willing to, that their pension savings are invested responsibly. And most of the debate, because that was debated a lot in the US, focused on the financial performance of social responsible investment. There was a lot of debate, as you can see, for example, in the article on the right, on their desirability in terms of fiduciary duty, and most of the debate was about, do social responsible investment offers the same kind of performances than traditional investment? That was the bulk of the debate. But there is an overlooked question, which is the one we tackle in this research paper, and that's the following question: does the offering of responsible funds affect investors' portfolio allocation and risk-taking behavior? So that's a question we are trying to answer in this research paper. I mean, as we all know, I mean, those working in the personal finance, household finance field, there is this famous stock market participation puzzle in most countries. There is a very low stock market participation. That's particularly true in Europe, but that's also true in the US, as you can see in the figure on the left here. And where you see that in average, the stock market participation before the financial crisis was around 60%, but it decreased up to 50% during the subprime crisis in the US and didn't recover after that. We are around 55% right now. So it's a relatively low stock market participation. It's even lower in European countries. And that is becoming a policy objective for different reasons. First, because there are large potential welfare costs for investors not to invest in the equity market. And that could also lead to rising inequalities. It has been discussed a lot, especially in an environment where we see more individualization of pension funds. So for example, pension funds moving from defined benefit to defined contribution. So meaning that individuals are more and more responsible for their asset allocation choices. So if they don't spontaneously invest in equities, that might lead to important welfare losses. Another important political debate is about the development of capital markets in Europe. And the European Commission is very keen in developing European capital markets. And it has also identified that the participation of the retail market, so of individual investors to the stock market, is a key condition for the development of European capital markets. So for all these reasons, the stock market participation of individual investors is particularly important and is really debated by academics and policymakers. So why don't people invest in the stock market that much? I mean, there have been a couple of reasons which have been demonstrated in academic papers. And that's a mix of various reasons, going from purely financial reasons, like for example, informational cost. It's costly to search information on the equity market and people don't have time for that. But also behavioral reasons, like for example, people have low financial literacy and those with lower financial literacy invest less in the stock market. Low optimism as well, so people are reluctant to invest because they don't trust that much the future economic perspectives. Life experiences, there is this famous paper by Malmondy and Nagel, for example, showing that people that experience bad performance in the stock market, they tend to invest less. Or also interpersonal trust, papers by Guizot and co-authors demonstrate that that has also an important impact on stock market participation. And the last type of factors that have been demonstrated are social and cultural factors, including social capital and also political preferences. And we're particularly interested in that factor. And I'm going to come back on that in the next slide, because political preferences or social preferences are also been demonstrated to be a large driver of the investment in the stock market. People that are left-oriented or in the US that are more prone to vote for the Democratic Party, they tend to invest less in the stock market. So we have this first set of results showing that, as I just mentioned, left-wing or pro-social investors, they're less likely to invest in stocks. And the main reason that has been given for that is a generalized antipathy towards capital markets. So that's what we can call stock market aversion. So left-wing or socially oriented people, they dislike stocks, and the main reason would be because they don't trust the capital market or they dislike capital markets. And on the other hand, we also know from another strand of the academic literature that there is a strong link between these social preferences and investment in social responsible investment. What has also been demonstrated is that these left-wing or pro-social investors, they are more inclined to invest according to socially responsible criteria. There is a couple of empirical evidence. There is this famous paper, for example, by Hong and Kostovesti, which is looking at how mutual fund managers invest and relating their investment to the donations that they make to Democrat or Republican Party in the US. And they show that mutual fund managers that donate more to Democrats, they tend to invest more responsibly by excluding stocks, sin stocks, and that kind of things. And they are following paper also showing that link between political preferences or social orientation and the desire to invest in socially responsible investment. And we can quote Riedel and Smith, a famous paper in the Journal of Finance, or more recently this paper by Anderson and Robinson. So we have these two sets of empirical evidence, one on stock market aversion, the second one on the link between personal values and social responsible investment. So if you add up these two sets of results, you can go to our conjecture. Responsible funds could allow pro-social investors to invest in the stock market while avoiding the cognitive dissonance of investing against their values, right? So if you add up these first two empirical results that were found by previous academic studies, we could make the hypothesis that the offering of social responsible funds could increase stock market participation. And that particular hypothesis has never been tested as such. So that's what we're going to test in the paper. So just quickly a preview of the results. What we do is that we analyze the portfolio choices of approximately 1 million active participants in employee savings plans in France. We look at their portfolio choice in 2017, and we find that the inclusion of responsible equity option in the funds menu is associated with an increase in stock market participation by the plan's participant. We add to that an analysis along the geographical variation in political preferences, because we know where people live, so we know their zip code, and we're able to match our data set with the results to European elections in 2019. And we find that the observed effect is driven by political preferences. So let's say the personal values or the social and cultural factors of individual investors, and not by risk return consideration. What we plan to do next, and if I have time, I will give you a preview of the next steps. So what we want to do to improve the paper. We would like to run the same exercise on an extended sample period, but more importantly, we would like to run a survey of plan participants, and I will show you what is the question that we would like to ask directly to plan participants to possibly better elicit their personal values and link that to their investment behavior. Okay, so let's say a few words about our empirical setting. We are analyzing savings plans in France. So for those who are not completely familiar with French employee savings plans, so in principle and in functioning, it's quite close to the 401k in the US. So this is supplementary pension systems that is provided by the employers. And we have two main types of employee savings plan program. One which is dedicated to retirement, like in the 401k, and that's called PERCO. And we have another one which is dedicated for medium-term savings, and that is called PE. And it's widely spread among the French workers, because if you look at 2016, around 56% of French employees had access to at least one form of such saving schemes. And there are specific rules that I'm not going to detail here, but again, which are quite close to the 401k. For example, the amounts invested are blocked for a fixed retention period. There is a default option, so contributions are automatically invested in low-risk default funds for those who do not fill their optioned preferences. And also there is matching that is offered for certain types of funds. And finally, and that's very interesting for us, it's mandatory for all firms that have at least 50 employees. Another very interesting feature of the French system is that all firms that have more than 50 employees must include at least one solidarity fund, which is one special kind of responsible funds in France, among the investment options. So that's particularly interesting in our setting because of endogeneity issues. I will come back on that later. But keep in mind that all firms with a sufficient large number of employees, they need to offer a responsible fund. And this responsible fund needs to be of this very special kind, which is called solidarity fund. And this type of responsible funds is required to invest between 5 and 10% of their assets in accredited solidarity-based enterprise that should have social utility. So these can be, for example, firms that invest in social housing or that employ disabled people. So they should demonstrate a social utility. But interestingly, the rest of the portfolio is invested in normal listed companies. And in average, if you look at these solidarity funds, which are very popular in France, you see that 6% is concretely invested in solidarity-based assets and 94% is invested in conventional equities, with typically a social responsible screening. And if you look at the figures, 83% is in average invested in ESG strategies. So there is still an ESG screening on this equity part. So on an analysis, we are going to focus to this investment in solidarity funds. So we're going to define responsible investing as investments that are made through the solidarity funds. So there are two main reasons for that. So the first is that solidarity funds, unless the normal SRI funds, that they have common characteristics that are defined by law. So all the characteristics I mentioned previously, they are defined by law. There is an institution, Financial, which is certifying that. So there is very little leeway in the way you can define a solidarity fund. And also because they are mandatory, and that's really unique to this type of fund, we are less concerned about the endogeneity nature of responsible fund offering, because you could always claim that firms that employ maybe more socially oriented employees, they have a higher incentive to propose that kind of funds to their employees, right? So with that obligation by law to offer solidarity funds, we are much less concerned about endogeneity. And in fact, we find that in our sample, around half of the savings plans offers one solidarity option, which can be either a pure diversified equity option, so it's a purely equity fund, or it can be a balanced option for 27% of the companies in our sample. Balanced meaning investing in equities and bonds. And we find, consistent with the regulatory requirements, that all firms with more than 50 employees offer at least one solidarity option, either equity for 27% of the funds or balanced for 78% of them. The data we have is the cross-sectional data on the portfolio decisions. And we're going to look at that at year-end 2016 and year-end 2017. And we also have the individual contributions that employees make in their plan in 2017 and how it is invested. So people receive variable remuneration, like in the 401k, they can invest in a funds menu, and then we can visualize how this new money that is received in 2017 is invested in the various funds that are available for choice. So we're going to look at how this new money that is received in 2017 is invested and which choice is made by individuals. And we're also going to compare the new money investment in 2017 with the asset allocation at the end of 2016. The initial sample is quite large, and it's approximately 4 million individual accounts, which can be active and non-active. And we restrict to employees who are actively contributing to their saving plan during the period under study. So that leads us to study slightly less than 1 million participants in around slightly less than 20,000 firms. Interestingly, the sample is covering 94 out of 96 French departments. So the sample is quite widespread around the French departments. So these are our summary statistics. And we have the first table about plan level variables, the second one about individual level variables. So I'm not going to show all of them, but just discuss the main explanatory variables and the main dependent variables. So in green, what you can see here are the main explanatory variables. So we're going to look if people, I'm going to come back on the specification in the next slide, but if people that are offered a responsible equity fund option invest more in equities. And what is interesting here is to see that 22% of firms in our sample offer a responsible equity fund in the funds menu. And we also are going in a diff analysis, I'm going to come back on that, to see if firms adding a new responsible equity fund in their menu are driving more investment in equities. And 1%, slightly more, 1.4% of firms in our sample are adding a new responsible equity fund in their menu. If we now look at the main dependent variable that we're looking at, they are at the individual level. We're going to look at the way the new money that is received in 2017 is invested and the percentage that is invested in diversified equity funds. Sorry, in diversified equity, either through diversified equity funds or through balance fund. We sum these two categories. So we sum the share of the balance fund that are invested in equities and the pure investment in diversified equity funds. And if you sum all that, people hold in average 14% in equities. So that's relatively small, consistent with what we know in European countries. And also we are going to look at how their asset allocation change between the new money investment in 2017 and their former asset allocation at the end of 2016. As you can see here, the average change is 4.28%. So these are our main variables of interest. What about the empirical strategy? We have two main econometric specifications. One is a cross-sectional analysis. That's the first equation here, where we compare the share of new contributions to the new money allocated to stocks in 2017 in plans with and without responsible equity funds. So we are regressing this share invested in equities on a responsible equity fund dummy, which is equal to 1 for firms offering a responsible equity fund option. And then to account for endogeneity issue, we are going to look at a diff setting where we study now the change in stock allocation decisions. So we are now going to look at the change in equity investment. So looking at the difference between the share invested in 2017 in equities for the new money, comparing that to the investment in 2016. So we look at the difference and we regret that on a dummy for firms offering an additional or new responsible equity fund in 2017. So we look if the addition of a new responsible fund in the funds menu is leading to more investment into equities between 2016 and 2017. That's the idea. So we control as well. So here you see the main cross-sectional regression result. And as you can see, I'm going to come back on the result, but we control for a number of characteristics, either at the individual level. So we look for gender, age, account size, that is a proxy of wealth. We don't have the full wealth of individuals, but we know how much euros they have in their account. And we also control for a number of firms' characteristics, and especially the matching formula that I mentioned before, because some funds are matched. So we control for the mean match rate, the maximum matching contribution, the number of funds that are offered, the percentage of equity funds that are offered in the menu, and also the number of employees. So let's have a look at the main results of this specification. So in these cross-sectional regressions, we are interested to understand if firms that offer responsible equity see their employees investing more in the equity market when we look at the new money invested in 2017. So the main specification is the first one that you can see here. And what we find is that participants in savings plans that are offering responsible equity fund, they invest in average 2.2% higher, more in the equity market than the rest of participants. So it's 2.2%, remember, relative to an average asset allocation, which is around 13%. So in relative terms, it means around 17% relative to their average asset allocation. That's quite sizable in relative terms. And it accounts for 1/10 of the standard deviation of the stock allocation in 2017. When we interact this responsible equity dummy with individuals' characteristics, so we do that for gender, age, and account size, we find that the effect is stronger for male, for young participants, and for individuals having a larger account, meaning more wealthy, as it is, or proxy for wealth. And importantly, we also check that the results are driven by the true investment that people do in the responsible equity fund that is offered by adding a responsible equity investor dummy here for investors that really invest their equity money in the responsible fund option. And we find that the results are driven by the participants' investment in the responsible equity fund. We run robustness checks for savings plans that have more than 50 employees. I mean, as I mentioned before, all firms with more than 50 employees must offer a solidarity option. So if we restrict to that sample, we are much less concerned about the possible endogenous nature of the responsible fund offering. Because as I mentioned before, you could always imagine that firms that are more responsible themselves, or that are employees that are employing workers that are more sensitive to the responsible offering, might be also more likely to propose social responsible funds. And so if we restrict to that sample, we don't have that concern because it's mandatory for these firms. Of course, the identification also relies on a smaller set of data, because now the differences come exclusively from people, the differences between people that are offered balanced fund, responsible balanced fund only, versus people that are offered also equity funds, right? So the main identification here comes from the difference in behavior between people that are offered only responsible options through balanced funds compared to people that are offered that also through equity options. But we still find a very significant impact of being offered a responsible equity fund of 0.48, which is still very highly significant. Second specification, again, to rule out these endogeneity issues, we are running a diff-in-diff analysis. So it's the same kind of setting, but we are now interested in the change in the asset allocation into equities. And we're going to see if this is influenced by the fact that some companies might offer a new responsible equity option in the funds menu. So that's what we can see here. If we focus on the main variables of interest here, what we find, and let's have a look at the second column here, is that when firms introduce a responsible equity fund in their menu, it is associated with an increase in the stock asset allocation by approximately 6.8%. It's 1/2 of the standard deviation in the variation in the asset allocation in 2017. Interestingly, we run also a placebo test. So we check that this is not just due to the addition of a new fund that might attract new investors. So this placebo test, we run it by looking at the impact of introducing a conventional equity fund, so one which has no social responsible screening. And what we find here is that in that case, there is absolutely no impact, even if a slight negative but not significant impact, of being offered a new equity fund in the funds menu. So that's for our main results. So the question now is why that? So what can be potential reasons why people are more likely to invest in equity when they are offered a responsible option? So according to standard finance theory, there should be no reason why this should drive more investment into equity. If you think that about two investments that should drive similar cash flows, for example, there is no reason why these should affect portfolio choice and why investors should invest more in one option versus the other. So why should responsible investing increase the stock allocation? So we may think about two potential explanations. The first one could be that investors may perceive the sustainability features of responsible funds as having higher risk-adjusted performance. So people might think that a socially responsible fund might have a higher performance than the conventional funds. I'm going to show you that historically it has not been the case in the sample of funds that are offered in the savings plans we look at. So that rules out this hypothesis. A second hypothesis we might have, and which is the one we are testing in this paper, is the one related to the personal values. It could be that responsible funds attract investors who would have been otherwise reluctant to invest in equity because this stock market aversion that some people might have. So if you are offered a responsible option in your funds menu, it might be that you are more inclined to invest in equities because that is more in line with your personal preferences. First hypothesis, risk-return differences. Here you see the difference in performance, so you see the conventional equity fund performance over 2010 up to 2009. And the solidarity equity fund performance, and you see that it's not significantly different among the studied period, and it's even slightly lower for solidarity fund without any surprise. So it's hard to believe that people based on their past historical experience that they should believe that solidarity equity fund should drive higher performance in the future. So to test for the second hypothesis that personal values might play a role here, we are linking our data to the results of the political elections, the European elections in 2009. So we know where people live, so we have their zip codes. So we are able to measure at the department level what are the results of the European election, and more particularly, we're going to look at the percentage of votes to the Green Party. And we do that because, as I mentioned in my introduction, it has already been demonstrated that there is a robust correlation between voting behavior and pro-social preferences, and also a link between political preferences and SRI investment. So we look at the department level percentage of votes to Green Party at the 2009 European election. And we also control, because that plays a role, for first, regional differences in GDP per capita. And also we control for social capital that is proxied, like in Guizot's paper, by the percentage of voting turnout. So that's our last table of results, where we show the impact of interacting now, the fact of being offered. So these are the cross-sectional regressions. In the paper, we also have the same result in a definitive setting, but here for cross-sectional regressions, it's the same setting than before, but now we are adding an interaction between being offered a responsible equity fund option and the percentage of votes to the Green Party at the European election. And what we find is that a very large part of the effect is driven by the percentage of Green parties. And we find a similar result if we look at the left-right political spectrum decomposition when we look at the interaction between being offered a responsible equity fund and the percentage to the left party, the percentage of votes to the left party. And that demonstrates that the effect of responsible equity fund on stock allocation seems to be concentrated in areas which have higher support to green parties. Okay, so maybe I can say a few words, if I have time, on what we would like to do next. Because to elicit these social responsible preferences, so these personal preferences, we were using this proxy of the political preferences which were measured at the department level. And of course, it would be much better if we could refine that measure by eliciting more precisely what are the personal preferences of investors. So what we would like to do is to run a survey of plan participants where we would randomize participants to 2 different treatment conditions. So half of our survey people would be randomly assigned to a conventional equity condition, and the other half would be randomly assigned to a responsible equity condition. And the question that would be asked to all would be the following. Suppose you have 10,000 euro and you need to invest it for 1 year. You have 2 possible options. You can invest in a safe asset with a return of 2%, let's say, and you can invest in a risky asset, which has an average return of 6% and a volatility of 18%. But the control group would be said that the risky asset is a conventional equity fund, while the treatment group would be said that the risky option is a responsible equity fund. So both would have exactly the same return and volatility, but they would differ in their social responsible nature. And we would ask exactly the same question to the 2 groups. How much would you invest in the safe and the risky option? Of course, what we expect from what we already observe in the empirical analysis is that the treated group should declare that they would like to invest more in risky assets. At least that would be consistent with what we observe in the portfolio decisions. So then we could run a basic regression where we regress the percentage declared to be willing to be invested in the risky asset on the dummy for treatment, and hope that this beta 1 coefficient should be positive. And we could further test the personal values channel by also asking in the survey questions about personal values, about stock market aversion, like for example in the paper by Costi and Torstilla, where they ask, do you consider that the stock market be overall beneficial or harmful for the society as a whole? And then run the same kind of regressions, but where we add an interaction between the treatment and the market aversion measure that will be measured from the survey equation. And again, I mean, if our hypothesis is true, we hope that the effects of responsible fund and risk taking should be stronger for market averse individuals or those having higher social preferences, etc. So that's the plan. That's what we would like to do with the survey. So just to conclude, what do we find in this paper? We find that responsible investing can increase the stock market participation of a significant part of the population. We think we make 3 contributions to different parts of the literature. First, on the literature on this limited stock market participation and how to increase it. Second, on the role and culture and personal values in financial decision making. And finally, also on the role of framing of financial offering and how this might offer portfolio choices. There is a wide and expanding literature on that the way you present things to individuals, especially in their pension choices, can have a huge impact on the decision they make. And here we see that the fact that we offer a solidarity option that has a little bit of solidarity investment, not that much, can drive much more investment in the equity market in general. There are also a couple of policy implications of these results. As I mentioned in my introduction, there is this huge debate and there are a lot of concerns around policymakers about the limited stock market participation. So concerns for pension adequacy, as I mentioned before, but also for the development of European Capital Market Union, as the retail market participation is considered to be really a key driver of the development of capital markets in Europe. What we show here that could be of interest to policymakers is that the attractiveness of equity funds do not only depend on their financial performance, but they also depend on their ability to attract investors that would have been otherwise reluctant to invest in capital markets. And so offering social responsible investment or solidarity investment in our case can attract investment above the financial performance, which are not higher and even lower than traditional conventional equity. Thank you very much. So I would be very happy to take questions and remarks.
Okay, thanks. So I have, thanks, Marie. I have a question on the general market, in the sense that we also have a paper on the Netherlands where we found that people are actually likely to buy more than actually social responsible bonds. We did it with both bond and shares, but actually they would even give up return rate to be social, let's say, in their investment. So I was wondering whether this, I mean, these people can also buy themselves products that are in more socially responsible. So is there a sort of, I mean, is it the only option that they have in order to buy socially responsible funds, or do you think that when the market becomes less thin, then maybe the role of pension funds into having this this option, let's say, it will become more marginal? So in the sense that they increase their participation in the stock market, but that's the only option that they have through pension fund. If the other institutions will offer specifically devoted products into like more social, then maybe this effect will not necessarily be channeled through the pension funds.
Yes, it's an interesting question. So we cannot observe, that would be great to be able to do that, the rest of their portfolio. So we don't know how they invest otherwise. So I cannot answer you based on the empirical data we would have. But it's true that there could be competition between various products that are offered in the market, and it's not clear that they should do it through their pension funds. So there is no reason why they should necessarily do it through their pension funds. What is particularly interesting in the French setting and in the French employee savings, so the pension fund that we are studying here, is the fact that it is mandatory to offer it, while it's completely free otherwise. So here we can see if it's commonly offered to a large part of the population, what is happening to their investments. But how much might that change? So it also means that they're exposed to that, because you cannot check if they go to their bank and if you're exposed to a social responsible fund offering. Here, you know they are exposed because it's in the funds menu, so they are aware that it's available and you can identify if it has an impact. But I agree that the fact that there was, the figure I was quoting at the beginning showing that there is a huge development in the retail market goes in the direction that you're mentioning, that it's also more generally that people go more for social responsible investments. So probably also when they go to the bank and invest their money.
So there could be even like a spillover effect in the market. And a second question, then I'm done, is about age. So we found, for example, in this paper that you control for age, I think, in the regression.
Yes.
But there is an education. So we found that education is a very, very strong determinant of investing socially, more than anything else. So I was wondering whether you have the data or you just don't have it. And age is
No.
also acting differently. So the young, we found that the young and not particularly rich, so sort of middle class, were the most and well educated, let's say, were really the most interested into the products. So I was wondering whether you could maybe break down also by age category, because maybe the age variable itself cannot capture this different propension to
Yes,
think socially.
that's a
So
very
maybe something
interesting.
interesting can
Yes,
come out. Thank
that's a
you.
very interesting suggestion. Thanks for that. So we didn't do that. Education, unfortunately, we would love to have that, but we don't. If we run a survey, we will ask these financial literacy questions, so that will allow us to check for this effect. But age, we could definitively do that to check more precisely which age category is more sensitive. That's a good idea. Thanks.
Thank you. I've seen Elsa Fornero would like to ask a question.
Yes, if it's possible. First,
Yeah,
I
sure.
want ciao, Marie. I'm very happy.
Ciao, Elsa.
I'm very, very happy that you are here, even if on screen and not personally. But next time. And I appreciated very much your presentation, and I love your topic of research. I have a very quick question. The question is this: we know that preferences in general and political preferences in particular are, well, let's say, influenced or conditioned by the degree of knowledge in general. And in the case of participation in the stock market, I believe that financial literacy can be important. So, for example, I do not want to say that the people who love green questions in general have lower financial literacy. But since you chose in particular the green area as the field of responsible investment, which I also believe, by the way. I mean, I do not want to underrate the importance of having policies that give more attention to the green problems. But in any case, I wonder whether it is possible to have at the department level some knowledge of political participation and the level of financial literacy. And if you can insert in your survey about financial knowledge, so that you can see whether there is, let's say, an influence of literacy, financial literacy, with respect to political preferences. I do not know whether it's clear, but we can talk anyway another time. Thank you.
Thank you very much. Thank you very much, Elsa. Thank you very much for this question. It's a very important one. So for the voting participation, we have that at the department level, and we control for that. And your intuition is perfectly right. We find that it has a strong impact on the. So it's one of our controls, but it's highly significant on the percentage invested in the equity market. So in departments where there is a higher participation to vote, there is also higher participation to the stock market. So that's probably in line with what you have in mind, that when there is more education, there is also more participation to elections, and that also these people are also investing more in the equity market. But at the individual level, we cannot control for the financial literacy, unfortunately, unless we have the survey that we want to launch that will be able to ask the question directly. Otherwise, we have no information on these people. So unless their age and their gender, so we don't know their education level, the type of job they occupy in the firm, that kind of thing. That could be a proxy for financial education, financial literacy. We don't have that. And I agree that that should be probably a channel, an important channel to study. Yes.
Okay.
Thank
Thank you,
very much.
Marie. Thank you.
I see Tadas would like to ask a question. Tadas, can I? No, wait, you should unmute. Oh, just a second.
Yeah,
Okay.
hi.
Perfect. Hi.
Hi, my name is Tadas Gudaitis. I'm from Lithuania and I'm from Vilnius University, but also partly working in the financial industry. So first of all, thank you for your presentation. I think these insights are very important coming into the future, and especially in this decade, which is generally dedicated, I believe, on all political and asset management, financial sector, and everywhere related with sustainability and its development. So I'm also a little bit maybe saying that I think maybe it's also would be quite an important to have another definition close to financial literacy, which I'm not sure is now is really debated, but something like sustainability literacy, and start to examine not only how people are financially literate, to understand the impact of interest inflation and equities allocation and diversification and stuff like this, but more about sustainability literature. And where I'm referring it, maybe it's also would be interesting somehow to link which of, for example, like one example, which of the motivators from the same ESG perspective, that there is these three letters means environmental, social governance, for example, which drives you to choose more responsible, sustainable funds. What kind of, which one of these letters are forcing you or forcing, let's say, driving to such thing, such type of investment? So I think sustainability literacy, such kind of the term or measurement would be interesting that it would be appear in academic, and I would be glad to contribute as much as possible with my knowledge as well. Yeah. So
thank you. I think the question.
So more if to say about the question. So maybe like suggesting a question, do you plan maybe also to measure which one of these indicators is helping people to select this fund? So maybe this is one question, and another one is a little bit about default option, because when we're talking about the selection of French people, I'm not so aware about the system, but is it this life cycle type of the strategy is more important than just to select more equities and to invest more into ESG?
Thank you very much. Sorry, Tadas, but maybe there are other people. Thank you very much for.
Okay, yes, so these are very good suggestions for the survey, so thank you very much. Yes, we plan to ask about sustainability literacy, so how much do people know about these topics, and that might have an impact on their preferences. And also to ask, that's also very interesting and very important in the current debate, because as you probably know, the European Commission is willing to implement direct surveys, at least that's something which is debated right now, of retail clients on their social responsible preferences. So exactly what you're asking, which dimension ESG, and among these dimensions, what are your preferences? That's probably in the next step should be asked by banks and asset managers and even pension funds directly to the plan members of the clients. So knowing better what people want is certainly a key issue, and we would like to use the survey to do that. So the default option has an impact. It's very important in people's choice. So the solidarity funds can never be a default option. So we checked for that because they're equity funds, so they are not considered as safe. So the default would either be a money market investment or, as you mentioned, a life cycle fund. So is it more important to offer, so that we didn't really check, so the type of default and its impact on the results, but in any case, that doesn't interfere in our results here.
Okay. So I don't see currently hands raised, so I would ask one question while maybe others could raise their hands or lit up their video. And I would like to play the devil's advocate. So here the premise is that there is underinvestment in stocks, and I very well know that that is the consensus. But there are also others who claim that maybe it is optimal under some circumstances not to participate in the stock market. And that's, for instance, the case when there is leveraged home ownership. And that could be the case if there is a possibility of personal disaster. If I understand correctly, the options that are currently offered among the solidarity funds are just either balanced or full 100% equity. If it is true that that some people would like not to participate, then it would be optimal from a policy point of view to offer also bond-only solidarity funds. So is there an institutional reason why these bonds-only were not offered, solidarity funds, or is there something I'm missing? Thank you.
No, it's a very good question. So no, you're right. The premise that we should have stocks can be debated, and certainly, I mean, you've been working a lot on labor income risk, for example, so that there are huge differences across individuals on their labor income risk, and it might certainly not optimal to invest in equity for everyone. So, and we have in the paper nothing about that. We don't say if it's optimal or not for people to do that. But it's definitely right. So bond solidarity options exist. There is nothing preventing to offer that. It's a very, very small minority of firms offering that. So we even do not mention the figure because it's a very small figure. Most firms offer either balanced or equity option. And it's a very good question. Why? I don't know. I could ask that. It's true that it's not something that firms like to offer to their employees. Yes.
And that is, sorry if I go on, even if a subset offered some bond-only funds relative to because one possibility is that people want to invest more in stocks. The other possibility is that they want to invest more out of cash, so that could also discriminate between the two possibilities. Whether solidarity drives investments per se in like riskier securities, or whether there is a special preference for stocks.
Yes, no, we rule out your hypothesis in a different way by looking at this placebo test, where we look at the introduction of conventional equity. And we show that when firms offer a new conventional equity fund, the people don't invest more in equities. So that rules out your hypothesis that people just want to go out of cash, and if they are offered something new, whatever it is, they go for that. That's not true in their behavior.
No, sorry, I didn't explain myself. If
oh, you mean solidarity
bond funds could help discriminate whether solidarity drives a riskier investment in general, or whether there is this additional effect.
I see.
That
yes.
Right.
No, I see your point. It's very interesting. We cannot do that because there are not enough solidarity fixed income, but we could do that with balanced, because here there are a large number of balanced funds. So that could be a way. Yes, the differential between the two could be a way to test that. So that's a very good idea. Yes. Thank you.
Thank you. Any more questions? I don't see any video on. If there are no other questions, then I would like to thank you very much, also.
Thank you very much for the invitation.
No, the invitation that, of course, we share, I share the invitation with Elsa Fornero, Maria Cristina Rossi, etc. So we are all very grateful that you gave us this very interesting speech. Thank you.
No, thank you. Thank you very much to all of you for inviting me, to Christina, Elsa, and yourself. It was a pleasure to participate, and thanks for your questions.
And thank you for all attendees. Bye-bye.
Bye-bye.